Barrington, we're seeing improvement. Is anything uniting the banks in their improvement, or is it very geographic and bank specific?
Well, I think across Europe through this results season, we have seen certainly a better beat to miss ratio in the fourth quarter. And I think that's being driven, actually, interestingly, by revenues. Revenues have been a little bit higher, helped by fees. Clearly, the asset management and private banking fee environment has been favourable, given markets, up until very recently, of course. One interesting feature actually has been costs are a little elevated, and I would actually argue that that is a sign of confidence from management. They see the revenues coming their way, looking at the forward rate expectations, net interest income should be rising, and the better companies are beginning to invest. And I think that's very encouraging.
And we saw
Specifically for Credit Suisse, I was going to say, clearly Asia Pacific has been a big help for them, and indeed for UBS. That wealth environment has been very supportive.
If we move down a little bit towards the Mediterranean, UniCredit saying it's going to give a dividend of 32 cents a share. Commerzbank as well as another one that's going to reinstate a dividend. Is the likes of Ray Dalio and Bridgewater, are they right to be shorting Italian banks now?
Well, you raised two interesting points there. One is the dividend, one is Italy. Italy specifically, we have an election coming up in a matter of weeks, and that is an issue that is of concern to us. At the moment, the polls indicate there is no clear party that is likely to have a majority. Indeed, it is likely there is not even a coalition group that is going to have a party, in which case it is conceivable that the five-star, who are currently polling the highest amongst any party, could be invited to try to form a government. I don't think the market is really prepared for that. Certainly not if they then went off and had a conversation with the Northern League. Those sort of headlines, I think, would be very uncomfortable. So in the short term, I have sympathy with some concern around Italy and Southern Europe. However, on the dividend point, I think you make an interesting point there, raising those companies raising the dividend. When we look out over the next couple of years, current European return on risk-weighted assets is around 120 basis points in 2017. By 2019, we think that's about 140. And on the basis of that, given a payout somewhere in the mid-50s, we're looking at a comfortable 5.5% dividend yield. That's the highest we've seen in Europe in well over 3 decades. Roll forward one more year, with the forward rate curve giving a little bit more help to net interest income, and you could be talking about a dividend yield heading for a 7 handle. And that's 2 times the best we've seen over the last 3 decades.